You know, when you look at a company's financial reports, you're supposed to be seeing the truth. But what happens when those numbers are, well, a lie? Today, we are going deep, right into the anatomy of corporate fraud. We're talking about a world of deception that can literally bring down empires.
All right, so let's get right to it. What separates an honest mistake, a simple typo on a spreadsheet, from a calculated multi-million-dollar lie? Where is that line? Well, the answer really boils down to one crucial word: intent. See, fraud isn't an accident. It's not an oops moment. It's a deliberate act of deception. So that begs the question, right? What on earth pushes someone to make that choice?
Well, it turns out there's kind of this perfect storm, a recipe for disaster that criminologists have identified. They call it the fraud triangle, and it's fascinating. So you've got three key ingredients in this perfect storm: pressure, opportunity, and rationalization. Think of it like a three-legged stool. If you take one leg away, it's unstable. But when all three are there, the whole thing stands up and the chance of fraud just goes through the roof. Okay, let's pull each one of these apart. All right, first up, pressure. And this can come from anywhere. We're talking about intense, top-down pressure to hit these completely insane earnings targets. Or maybe it's personal. Someone is drowning in debt. It could even be the fear that the whole business is about to go under in a tough market. It's that feeling of being squeezed. Okay, so you've got the pressure, but that's not enough. You also need an opportunity. This is that moment where someone spots a weakness, a little crack in the armor of the company's systems. Maybe the internal controls are a joke, or there's just no one really watching. It's that thought, hey, I could totally get away with this. And then there's the final piece of the puzzle, and maybe the most fascinating one: rationalization. I mean, nobody wakes up in the morning and thinks, I'm going to be the bad guy today, right? So they have to justify it to themselves. It's this internal story they spin. Things like, oh, I'm just borrowing the money, I'll pay it back. Or, it's not a big deal, everyone does it. It's how they sleep at night. Okay, so that's the why, we've got the motive. Now let's get our hands dirty with the how. And the first major method is a classic. You've definitely heard this phrase: cooking the books. So what does cooking the books actually mean? Well, it's all about making the company's financial report card look way better than it is. We're talking about straight up faking sales, hiding massive debts off the books, you name it. The point is to fool everyone, investors, banks, you, into thinking the company is a rock star when it's really on the verge of collapse. Right, method number 2 is a lot more direct. It's called misappropriation of assets, but let's be real, it's basically just stealing right from the company cookie jar. Yeah, this isn't about making the company look good. This is about making yourself rich. It can be small scale, like an employee pocketing inventory, or it can be more elaborate, like setting up a fake company and having your employer pay fake invoices, or it can be as simple as taking cash right out of the till. The methods are endless. Now, check this out. One of the most classic, kind of brilliant schemes for this is called teaming and lading. Here's how it works. An employee gets a check from customer A, but instead of depositing it, they pocket the cash. Uh-oh, now customer A's account is short. No problem. When customer B pays their bill, the employee uses that money to cover customer A's account. And when customer C pays, you guessed it, that covers B. It's this crazy, stressful shell game, constantly robbing Peter to pay Paul, all to hide that first theft. So if you want a really simple way to keep these two straight, just think about it like this. Cooking the books is fraud for the company. It's done to make the company look good. Stealing from the cookie jar is fraud from the company. It's done to line someone's pockets. So with all this sneaking around and cooking and stealing, you've got to wonder, who's the detective in this story? Who's supposed to catch them? Well, that's where the auditor comes in. Now, an auditor's main job is to check the books and say, yep, these are basically correct. They're looking for what's called a material misstatement. That just means an error big enough to make you change your mind about investing. But here's the tricky part. Finding an honest mistake is one thing. Finding fraud? That's a whole other ballgame. Why? Because fraud, by its very nature, is designed to be invisible. And it gets even harder when it's the folks at the top doing it. Think about it. Management. They're the ones who create the roles, the internal controls. So they know exactly how to get around them. It's like the fox guarding the hen house. That makes management fraud way, way harder to uncover than something an employee might try. So what happens when an auditor does find something big?
They can't just shout it from the rooftops. There's a very specific, very serious protocol they have to follow to sound the alarm. Let's take India as an example. There, if an auditor suspects a fraud hits a certain magic number, 1 crore rupees, which is 10 million rupees, a whole different set of rules kicks in. It's a serious threshold that triggers a mandatory reporting process. And when that happens, the clock starts ticking. Immediately. The auditor has just 2 days, that's it, to report what they found to the company's board. The board then gets 45 days to give their side of the story. But here's the kicker. After that, the auditor has 15 days to send a full report straight to the central government. It's a system designed to make sure something this serious can't just be, buried internally. So this whole process really highlights the fundamental tension here, doesn't it? Fraud is a game of deception, of hiding the truth. Auditing is a process of verification, of finding the truth. Which leads us to a pretty unsettling final thought. If fraud is designed to be hidden, and auditors have their limits, just how much deception actually slips through the cracks?